everyone, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and today we're not going to be analyzing an individual stock. Instead, I'm going to talk about why I reject stocks quickly. So I've made a couple videos now where I show people how I sift through stocks really quickly, usually about, if it's just an initial kind of run through, one per minute maybe is how long it will take me to decide whether I want to reject a stock just on the initial run through or not. It's been noted that I'm a little brutal when it comes to that, to rejecting stocks. And I think on the videos that I made, 2 out of 3 stocks that were in the mid cap index that I was just going through as a sample were rejected for one reason or another. And I want to point out some research of why it makes it easy for me to do that. And so let's just take a look at that right now. So this is from the University of Arizona State University, and one of the professors there, Hendrik Bessembinder, I don't know, several, actually there's more people on here, Francis J. and Mary B. Labriola, have done this research on investment returns from the stock market or individual stocks in the market since 1926. And there's some new research too. So I want to show you this. And I think when I learned this at one point, I know how many years ago it was, maybe like 8 or 9 years ago, it really was formative with me when it came to developing investing strategies, what's a good structure to go about doing it. Very few people do this the same way that I do, especially investment writers. And one of the takeaways you'll find here, I'll talk about in just a second. So the core thing here is 4% basically since 1926. Okay, 4% of all the stocks that have been trading basically have accounted for the gains of the market. Okay, 96% returned the same as 1-month treasury bills, so like cash. So if you were just going to throw a dart at a stock list at any time basically during this time, odds are 96% of the time, whatever it hit, you would be better off holding cash basically. So you have a 4% chance of hitting something, a stock ticker or whatever, that would actually produce positive alpha returns over treasuries. So that's an important thing to keep in mind when you're going about looking for stocks. Most of them are going to be not good investments. So they have an update here. I'm just looking at they do have links, by the way, here to the actual study, and I might pull up the abstract here so we can look at it. So this is the newer one from 2019, and I think they have numbers that go all the way through 2022 now. So this is a little bit more updated from 1991 until basically today, to see what they've been like. Because we had the Great Depression. I mean, we had world wars and everything since 1926. So to see kind of what the differences were, or where we have stood the last 30 years. So this found that 55% of U.S. stocks do worse than cash, okay, 1-month treasuries. So again, if you're throwing a dart or you're just guessing, chances are you're going to get worse returns than just not investing at all right? If you're just randomly picking stocks. So one of the implications of that, well, let's also look at the top performing 2.4% of firms accounted for all the net global wealth, okay? So you have 2.4% of big winners and 55% outright losers, right? And then I would assume that the ones that fall in between that, the 40% or so, produce some sort of positive return, but maybe not enough to contribute to very much to the overall thing. There's probably like a bell curve at that point, where, if you think of alpha as a CAGR percentage, some certain percent of that 40% would produce a 1% alpha, 2%, 3%, 4%. Probably these top firms would create a much more. But you kind of can see where if we just categorize this into the top 3%, we'll call produce great returns. The top, 30 or 40% produce okay returns, and then 55% or so produce battery, like losing money. So, and you got to remember, every time you buy like a stock that's losing money, that takes away from the gains of the ones that just do so. That's why only 2%, 2.5% or so account for all of it, because the 55% that lost money basically ate away all the gains of the mediocre returns, right? Of the other 43% or 44% or whatever of stocks that were kind of in the middle. So they kind of balance each other out to like zero or treasuries or whatever. And you're really left with just that 2.4%. So if you're going through a random stock list like I sometimes do, or just people ask me about stocks all the time, I know that if I just randomly rejected everything, I would be doing the right thing, pretty much. I mean, on stock by stock basis, right? So there really needs to be. I'm looking for that 2.4% is what I'm looking for, or maybe we can call it like a 3%. So, and then you're not going to be right all the time. The thing is, you want to be able to cast a wide enough net to capture as much of that 3% of big winners as possible, but not so wide of a net that you capture too many of the 55% losers, right? So, and then especially the big losers, right? So that's the game basically that we're playing at. And it helps to have an unconcentrated portfolio. So I usually take 1% weighted positions. And that really helps me because I get feedback on how I'm doing, basically. So after you get enough sample sizes, then you can adjust your strategy a little bit based on kind of what you're learning from how those numbers. You get a big enough sample size, you can actually learn something from what you're investing in. So I haven't looked at the exact numbers, recently, but my experience has been like when it comes to these like really big losers, like 1 in 50 is about what I get. I've had, that sounds about right. Like 1 in 50 will be 80% or worse, like just total disasters. And then there's a whole other group that can underperform for a while or things can go wrong. Usually it's stuff like accounting issues, or things like that, but that aren't really necessarily knowable. But again, the structure is set up in such a way that if I place enough bets, it will make up for those kind of rare mistakes. But I really do, it's the most important thing almost is to limit the losses, right? Limit the bad ones. That's like rule number 1. And then the next rule is, if you can limit the bad ones, you want to cast your net wide enough to get the really good ones, and then try not to sell them, too early. If they are going to be big long-term winners, you want to be careful about selling them. So selling them too soon, right? And that's really, that's really the entire game for the most part at the structural level. And most people don't really think of it in those terms, so they come at it like let's put it this way. Like if you look around at analysts and like how many buy ratings they have compared to how many sell ratings they have on sell side research, it's like 9 buy ratings for every one. I mean, I didn't even look it up. It's probably worse than that, actually. It's probably, there's almost no sell rating. And so that's completely backwards of reality. So that ought to tell you. Now, time frames can matter too. They're usually looking at like 1 year into the future or something, and these are long-term prospects. But really, I would say in the short term, nobody knows what's going to happen with the stock price, especially. They might kind of have an idea what earnings are going to do, but in terms of the actual stock price, nobody really knows in a year what's going to happen. So they end up being right half the time and wrong half the time, and that's just the way the game is played. It's more about getting people interested in stocks that they can. But the problem is people come in primed with the idea where they're going to find all these deals. They're going to find that needle in the haystack. And like most of this 2.4% are not like secret stock. They're not secret businesses and secret stocks that you're digging out of the bottom. I mean, one of those comes along every now and then, 1 in 1,000 or something, and it's great if a person can get one of those. But these aren't like super secret businesses, you know. Usually they grow enough or they get eventually included in like the S&P 500 or something like that. And so people know, you know, the business is a good business, like it shows itself, which is why I use historical evidence, historical earnings a lot as the primary guide, because businesses are like these machines and algorithms that kind of keep repeating their thing as much as they can to create money. And so if they've shown they can do that pretty consistently, you get a better idea of what they can actually really do. Now, it might not last, which is my next topic here, is if you look at the Dow Jones Industrial Average, which is a good thing to look at because it's been around forever and it only has 30 stocks. If you look at where it was in 1991 when that research was started from 91 until, or 1990 or 91 until 2020, the Dow changes very little. Like we can look at some of the changes each year, but even though it's changed very little, and these are basically in any given time the best businesses in the world, from 1991 until 2020, like 30 years, more than half of these stocks were replaced. It was something else. And if you go, this is Wikipedia. If you just go to the Wikipedia page, you can look at it. It's pretty interesting. They show what I tend to visit this like once every couple of months for one reason or another. But this is just a great framework. So let's look at some of these, like from 91. Kodak, bankrupt. General Motors, bankrupt. Sears, bankrupt. I'm not sure what else we have. So we have at least 10% of the companies are bankrupt. I'm not sure what happened to Bethlehem Steel, but I'm sure it wasn't like a great. And then you have like Alcoa. I mean, some of these. But so let's just say 10% of these companies went totally bankrupt, okay? And about in between half and 2/3, it depends on how you count them. They've actually added and removed almost 30 stocks, so almost the whole thing over the past 30 years, about one per year. But some of them have been the same, like AT&T's kind of popped in and out, and then there's been mergers and things that have kind of changed things in that regard. But anywhere, I would say about 2/3 has been replaced, is different than it was in 1991. So even the best businesses, the most stable businesses in the world, basically in 1991, half of them are going to be on the decline over that time period, or completely fail. And you don't get kicked out of the Dow unless you're doing badly. So if 2/3 are removed for one reason or another, that means really only 1/3 of these businesses have done really well for 30 years since then. And so even when you're dealing with really well-established businesses, the odds are pretty similar that, you know, half to 2/3 of them aren't going to do well long term, you know, really long term, like 30 years. So it kind of, you can't just say, well, buy and hold the good ones. Well, the good ones die sometimes, or they just stagnate and they don't go anywhere. So investing is not easy, but I think it helps if you just have the right context in mind of kind of what is this really all about. Ideally, you want to try to find early stage growth companies that enter the Dow at some point, right? I mean, that's kind of what you really want, that type of dynamic. But it can be really hard to predict which of those are going to be. So, like I'm just going to scroll up to what's in there now. today. So we have Amazon, right? Wasn't even invented yet in 1991. Apple, a totally different, completely different company than it was then. Cisco wasn't. They might have been traded, but they weren't very big yet. Home Depot was quite small. The Home Depots are what you want to find in 1991. Walmart, again, that wasn't like necessarily early stage Walmart, but it was smaller than it is now, and you could have done pretty well. Microsoft, obviously, it's gone through 2 growth phases since then. So you want to be buying these back in 1991 if they're available, like early on in their kind of growth business life cycle. And if you can get just a few good ones and hang on to them, you can do well. But it's not easy. Thousands of other businesses came and went during this time. Thousands of other publicly traded companies. So this is why it's very easy for me, if I don't have the information, to either, at least for now, just say, look, it's too hard for me. Sometimes it's just obvious that it's not probably going to be very good. And I know the odds are stacked in my favor. The more quickly I reject them. Now, I think in the research, this is the abstract from the actual research paper, they looked at 64,000 global common stocks. So not all of these are really investable for like a U.S. investor. In the U.S. markets, maybe like 4,000 is more what you're looking at. But that's a lot of stocks. So you don't want to spend too much time. If you're really doing these super in-depth analyses, you can't do that for every single one of them. And it might not even reveal the real secret that's going to make the successful ones be successful. Often that's the case. Like, you have kind of a good management and they're doing a pretty good business, and then they stumble onto something that like takes them to like the next level. It's not necessarily predictable, but it's more likely to happen with good businesses than bad businesses, in my opinion. So there are some things you can look for, but I try to go through quickly and reject the ones, that don't look great, don't look like they have the potential quickly. And then every now and then one will come along where it's kind of borderline, and I just kind of, I'm like, well, let me think about it. I can see possibilities and I'll put it on my list, and every now and then I'll check back in and kind of see what happens. But it helps keep me from rushing in sometimes when I know that the odds are most of these are going to be bad. So, all right, I probably rambled on a little bit too much here, but I'm going to leave it at that and just let this kind of information kind of sink in and sleep on it for a while, and then it can really help you have a very more rational approach, I think, to going through and sifting through stocks, looking to try to find the good ones. All right, if you enjoyed this, hit the or found it useful, hit the subscribe button. I do a lot of individual stock analysis on this channel, and then I've been making more videos like this that talk more just about investing in general. And I'll see everybody later. Thanks.